Hi, good evening to everyone. I'm Mohammed Majhal Islam, the host and moderators of this event on credit assessment and loan approval process that is followed by most of the banks in this part of this world. Uh, it's our great pleasure and privilege to welcome all of you to today's event. We are truly honored by your presence and we deeply appreciate that you took the time out of your busy schedule to be with us. Let's make this event meaningful, enjoying, and memorable together. A very warm welcome to each and every one, all of you. Mr. Piyush, if you can introduce yourself, please.
Yeah, sure. My name is Piyush, and I'm banker with 25 years of experience. And I've served all the leading private sector banks in the country. And the names include ICICI Bank, Axis Bank, IndusInd Bank. So these are primarily Indian private sector banks. The first decade was majorly into the branch banking, which is the liability side of the book. And the next decade was into the asset side. So 2000 to 2010, I was into branch banking, taking care of flagship assignments all across the country. And after that, 2020, 2010 to 2025, next 15 years were into liability side. And during that time, I served banks as well as I served few of the NBFCs also. Those are non-banking financial corporations, the leading ones in the country. I am Lucknow alumnus and MNIT Jaipur alumnus. These are the premier institutions in management in the country, and I also do a lot of consulting around private equity, debt fundraising, debts, NPA resolution, IPO. So I help SMEs in their entire journey, right from raising debt from the scratch to the period when they are maybe 7 to 8 years, going forward maybe 15, 20 years, all the stages wherein they would need debt to start up or maybe equity to start up, followed by certain debt. Then they become a mid corporate, and then maybe once they become a large corporate, then they would like to come up with an IPO. So the entire journey is covered, and I operate out of Jaipur, but I actively involved across the country. Uh, you know, uh, so that's about it. And I'm really thankful to all of you for having me over, especially Mazhar and Nurul, because it's a forum where I would really love to interact and share whatever pearls of wisdom I have, and would also love to know more, from you guys as well. So looking forward to it. Thank you so much.
Thank you. Thank you, Piyush, for your nice introduction. And after hearing some nice speeches and experiences from you, I believe that you are the most appropriate person who can talk on today's topics, that is loan assessment and approval process that is particularly used by some commercial banks when they approve some bank loans, particularly to the SME sectors. Okay. So we have already received a couple of questions from our entrepreneurs or who follow our pages. And besides that, if dear participants, if you have any question or any queries about our session or regarding your opinion or your ideas, please you can share your opinion or your talks in our chat box. That is, we have already opened our chat box for you, so you can drop your questions so that our mentors can answer those questions. Okay. So my first question to you, Mr. Pius, is that when a bank says capacity of a particular entrepreneur or entrepreneurs, what exactly do they mean? And what's the easiest way for me, such a for a startup or new entrepreneur, to prove that my business can readily repay a loan?
Right, right. So basically, the word capacity from a banker would mean two kinds of capacities. The first would be the repayment capacity. Whichever loan is being given, how will it be repaid? Whether the fund flows are sufficient enough to cater to the EMI demands or the interest payments. And the second piece is assets, because whenever a bank lends money, So the bank would love to have adequate assets hypothecated with them so as to cover any kind of unprecedented risk or a default or a non-payment. So they would like to have this covered. Now, since you added a word for a startup, that is someone who's just started a particular business. Now, for a startup, I've been interacting with lots and lots of startups, and the typical journey that I've seen here in India is, what happens is that when a startup commences the business, this business, the first round of funds is raised among the friends and family, and the person also chips in with his own contribution. And these funds would suffice for at least 2 years, 2.5, 3 years. Till that time, he would keep on funding the project from this particular ecosystem only. Now, once he has got a track record of 2 or 3 ITRs, right? He would have submitted income tax returns for 2 years or maybe 2.5, 3 years. So every year you have to submit this. So once you have a track record, once you have this banking history wherein you're receiving all the payments, you're making all the payments. So once you have all this compiled together, then that becomes an evidence for you to prove to a particular banker or a debtor that you can repay this much amount, particular, whatever is the requirement. So that's how you kind of go about executing the business. I mean, from the day one, if someone thinks that from ideation stage he should start getting money, that's a very very rare phenomena. Generally happens at the premier incubation centers wherein there are mentors involved, and these mentors, since they are working on these projects from day one, they would know, okay, this project can be funded, so maybe they will come up with some their angel investment, or maybe they will help them raise money from the incubation center which has a budget for it. So that's very rare, because now it's started happening that the first real round of raise of funds happens generally around sixth to seventh year in India. Not before that. Earlier we were lucky. I mean, the startups were raising money quite early during the initial stages also. But one has to be really have a very strong concept, and has to be really really fortunate to have money right from the ideation stage. It doesn't happen that ways. So that's how you go about it.
Thank you. Thank you, Piyush. Your presentation was so much accurate and target-oriented. I really enjoyed your speech. So my second question is that if my personal credit score isn't high enough that a commercial bank usually expect from me, what can I realistically do to improve it?
Yeah, there are some very easy ways and means to go about it. See, there are two kinds of people. The first time borrowers, whom obviously, since they are first timers, so they would not have any history, so they would like to make one for themselves, one track for themselves. And the second kind of people are some business persons who are maybe unaware, or maybe who are unable to manage their credit score. So those are people who have a poor score, and they find it difficult to raise money. So these guys, they can have some loans which are easily available. So, for example, you can have a fixed deposit done, and on that fixed deposit, you can have an overdraft facility, or you can have a credit card made on that fixed deposit, and you start using this money and start paying it back in time, right? So once you do it for 6 months, around 6 months, or around an year, this time is enough for you to really improve upon your score, or maybe make a fresh one. These are two small things which one can do. So and then see, one needs to be very very careful here, in the sense that there are times when we out of our sheer concern, we become guarantors in a friend's loan. Maybe we become a co-applicant in a friend's or some family member's loan. Now, there, if the person is not paying, it has an impact on your score as well. So one needs to be very, very careful, that in such cases, either you pursue the person to really be regular with his payments, or else you chicken out of that particular loan. Or thirdly, then this is the only way, which I just discussed earlier, you can really improve upon your score. So that's these are the ways you can easily manage it. Yeah.
Thank you for your uh, nice presentation again and showing your insights with such clarity and passion. It was very privileged to listen. So, my third question to you is that how do banks typically decide whether my business has enough collateral, that is collateral coverage? And what happens if I don't have traditional assets like land or building?
Sure, sure. So there are initially, when you approach a bank and the bank goes through the records of your collateral. So the first thing that a banker sees is the marketability of the collateral. That collateral should be feasible enough to for them to dispose of in worst case scenario. So they would see whether it has got a proper access. It can be sold if at all need be. However, as far as the amount is concerned, so generally, depending upon the type of collateral, we lend to the borrower, and there is a term called loan to value. Loan to value. So, whatever value your asset carries, a certain percentage of it becomes your eligibility based on that asset. So for example, if you've got an industrial property, generally 50% of that value is your eligibility. If you've got a commercial property, 60% becomes your eligibility. If it's a residence, then it becomes 70. You know, there are deviations based on your financial strength. So, this is one way of deriving eligibility based on your assets. And there is one more way of deriving your eligibility, which is through the monetary records, your P&L balance sheets, your banking history. So based on that, we derive one more value. Both of these values, whichever is lower, becomes your eligibility, right? Now, if the financials are very good, and we know that this person can pay really, easily, so your eligibility becomes slightly higher. I mean, there are deviations wherein 5% extra or 10% extra loan to value is, accorded to you, so that you can, if at all, if you are having 50% eligibility, you might be given 60% of the value of the collateral. There is one more aspect to it, and in case someone doesn't have a collateral, then how can one go about it? So it is a possibility that person might be operating out of a rented accommodation and might be having some machinery which is of his own, plant and machinery which he owns. So in that case, you can have exclusive loans on those plant and machineries. That's number one. The second piece is there are unsecured loans which are available, which are purely based on your financial track record. And the financial track record would mean earlier loans that you've taken, or the kind of financials that you have, P&L balance sheets, etc., that you have. So based on those revenues which are showing in your ITRs, you become you eligible for unsecured loan. There you don't have to give any collateral. It's purely based on your credit history, or it is purely based on your financial strength, right? These loans are known as unsecured loans, and these are very costly. So typically these would cost you around 50% onwards till 24%, and even higher. Whereas if you take a secured loan which is backed by a collateral, this typically would cost you somewhere around 9% to going to about 13-14%. So these broadly are kind of loans that you can raise in case you don't have a collateral.
So, can I ask you a something important question? That is, suppose I am a new entrepreneur and I am an IT firm, small IT firm, and I am selling some software or business solution. So, what could be my appropriate way to get a soft loan from a particular bank?
So when you have a company which is into IT product selling or maybe services selling, on a regular basis, you would be raising invoices on your principals, and these invoices can be discounted. That's the first way of raising debt. Secondly, you can raise debt based upon your financials, right? Wherein uh, your profit, whatever profit you earn, and we kind of there's a lot of calculation that comes into play, and I would just briefly touch upon it. So, whatever depreciation you are claiming in your P&L, that gets added to your eligibility. So there is a revenue that you are earning, then there is a depreciation which you claim on your assets that gets added because it's a notional loss. It generally doesn't happen. The third piece is whatever interest, if at all you are paying on any kind of a loan, that interest also gets added back because it becomes your, again, your revenue. And the fourth piece is if the directors, the owners are deriving some salary, so that salary also gets added. So in a way, your actual income gets enhanced, because you are adding depreciation to it, you are adding that, which is the notional thing, and you are adding salary of the directors or the owners, and whatever interest you are paying. So it gets augmented your revenue. So based on this, you can be given an unsecured loan. So this is the second way of kind of raising debt. Third is obviously, if the company is small and uh, the owners are in a position to really use or leverage their financials, so they can take a loan and which can be utilized for the company's benefit. That can also be done. So these are broadly three things, three which come to my mind. Obviously, in case of exports, if you are exporting your services or your products to a particular country, then obviously again those bills can be discounted. So those work orders can be submitted that will help the bank really know that how much is the incoming revenue that can be provisioned for, and that will help decide what can be the eligibility, how much amount can be lent, which can be easily prepaid. So that's
Thank you, Bruce. My next question to you is that if my business operates in a tough or declining industry amid slow or moderate economic growth, how can I still convince the credit officer that we are a safe bet for financing?
sorry, please come again. I just missed out. Yeah.
Okay. If my business operates in a tough or declining industry amid slow or moderate economic growth, how can I still convince the credit officer of a particular bank that we are still a safe bet for financing?
So see, what happens is that any business generally goes through ups and downs. That's not an abnormal thing to happen. Uh, and there are a lot of ways by which you can substantiate your claim to that particular loan. The first is the track record, the personal track record of the owners. So the academic background that they come with, the initial work that they have done. They must be employed somewhere, and then later on, maybe they decided they would do something of their own. So their earlier track record, the work that they've done, becomes a proof that they know it all, right? And the third piece is, you can share the projections or whatever is happening in the macroeconomy. So, for example, in that particular industry, there are some new developments which have happened in some other country. Those can be used to substantiate your claim, right? So there are these ways, through which you can tell the bank that not necessarily we will stick to this particular trajectory. The trajectory would improve, would enhance, going forward, and so you can really give us money. So that can also be done, right? I mean, all these things. It is all about the conviction that you have on your business, on your revenues, that actually convinces the bankers also. After all, they're also human beings, and they would like to have that faith in you only if you have faith in yourself, right? So these are things which really help the banker to assess that yes, these guys can be kind of given a better amount or a loan, despite downturns in that particular industry. So that's about this.
Thank you, Piyush, for your valuable points. My next question to you is, in every practical terms, what financial ratios like debt or debt equity ratios or some other debt ratios matter most to a particular banks, and what's considered a good number, a rational number to get a particular amount of loan?
Yeah. The most critical of the ratios that we as a banker see is the debt service coverage ratio, right? Current ratio obviously uh, is there, but the most critical nowadays that we see is the debt service coverage ratio. Now, this ratio is the number of times that a revenue can cover the EMI being, which one has to pay, right? So, if I have to pay a rupee kind of an EMI, my earnings should necessarily be at least twice, right? Uh, Generally. But then if I am a big business and I'm already leveraged, I've taken some loans even earlier. So there are times when I can come down to even less than a 1% of debt service coverage ratio. I can go up to 0.87, which means that even if my earnings are lesser, I can still be entrusted with a higher EMI. And this confidence emanates from the earlier track record that you have, uh, the earlier loans that regularly you've paid. And this also emanates from one more factor, which is the kind of income that you have off books. Because in our subcontinent, we do not show the entire amount on books. There are certain incomes which we receive in cash also. So if a banker is confident that that income is also there to support, so we can go to a smaller ratio also, like 0.87. So in India, like typically we go up to 0.85 DSCR, which means that 85 paisa income, and we can still give them we can interest him with a EMI of 1 rupee. The earning is lesser, but the earning is 85 paisa only, but we are interesting with a loan which is worth 1 rupee. So that's, and then the other ratios, obviously the current ratio typically 2:1, 3:1. This ratio is again very very critical, wherein obviously current assets that they come into play. And then there is this ratio which is, as I said, LTV, loan to value. This ratio means that how much collateral cover is there for the loan which is being given to the customer. So ideally it has to be more than 100%. So for example, if a person wants to get a loan of 100 takas for Bangladesh, so this collateral has to be of at least 120 takas, right? Not less than that. So that's also one of the ratio which comes into play. Mostly these days, we check the eligibilities through the SCR. Yeah.
Thank you, Bruce, for your insights. My opinion is that all the data you have shared with us can vary from customers to customers and sectors to sectors. Because if I think a particular sector is very much promising, future cash flows are very much certain. So then we can compromise some sort of ratios like DSCR or debt equity ratio, because I'm very much certain about the future cash flows. So when my business risk is high, that is very much dependent on the economic growth or sustainability of that particular sector, then I have to discount those cash flows. So my debt equity ratios, and then I will always try to cover my position, my exposure towards that particular client to a high DSCR or high free cash flow or free operating cash flow, so that my all the installments or EMIs can be repaid back by the clients in due time. Thank you. Thank you for
I agree.
your nice insights.
Mazhar, I'll just supplement here with one more data point. So here, there are times when we come across some very strong profiles, and we figure out that maybe the debt equity ratio is less than desired, and maybe current ratio is not up to the mark. In those scenarios, we give them unsecured loans also. So for example, if they are offering a property worth $100, and the loan we can give them is $80, whereas they need money, maybe $110, then what we'll do is that we will lend them that $30 worth of unsecured loan. and the repayment period of that particular loan would be lesser. So typically, when we give them a secured loan, it's for 12 years, 15 years, 20 years, 25 years. Whenever we give them unsecured loans, these are for a lesser time periods of 3 years, 5 years, 7 years, maximum 7 years. So this particular piece of $30 would be for maximum 7 years, and it would be needed to be paid early. Obviously, the repayments would be faster. The rate of interest would be differential. It would be higher. So that also becomes a factor. But then at least the person gets the money he wants, right? And whenever he has adequate money, he can pay it off. That's always welcome.
Thank you, Piyush. You've connected the issues very precisely, and which is very much commendable. Thank you very much, Piyush. My next question to you: can you explain what sort of stress testing banks might do and what they look into my business?
What kind of, sorry, please come again. I just missed the first part.
Sure. My question is, can you explain what sort of stress testing a particular bank might do on my business financials and what they look into my business? That is when
Right. So
they receive my proposal, what sort of stress testing, what sort of test they want to do, or do some sort of analysis on my projected financials, and what they expect that all the figures will show in my business
yeah,
financials.
yeah. So generally the bankers uh, try to stay very, very conservative, and they would always assess a particular loan on the worst case scenario basis, assuming that the things are not going right. Then what can happen, and how can we still recover the money, and how can the person still pay the money, right? So in this scenario, generally what we do is that we would, as a banker, I'm saying that whatever margins the person has quoted in his P&L, so we would try and check it with the macroeconomy. Generally, we will have an outlook checked as to are these the ratios which are there, or these are extrapolated ratios. So we'll try to moderate it. We'll try to make it slightly rationalized so that we don't go overboard. Neither does the customer get a feeling that he's duped us. He's kind of made us a fool. So that we do. So we obviously take a very conservative margins. So for example, in case of certain businesses, we have 20% margin. Uh, and what we will do is that we will maybe provision for only 12 to 15% margin, right? That's number one. We stay conservative. The second thing is that we would always see the kind of track that the person has had. So we generally ask for 3 years, financials, and that is to know that how the business has grown over the years, right? How has the recent trajectory been? Because if there has been any abnormal blip, that actually makes us alert as to check where has the person gone wrong, where the business gone wrong, and whether there is a chance of recurrence. So we also, kind of look into that. The third piece is, there is a general observation which is made, which is vis-a-vis the kind of vintage that the business has, and the kind of turnover that the business has reached. That's also observed. So, for example, a person who's doing business of 20 years and is still around a very small figure of 2 to 3 crore kind of a number, which a person generally can attain maybe in first 3 4 years, that should raise a question mark. What I'm saying is that if the turnover is not commensurate to the vintage of the business, then that doesn't evoke much confidence, right? So we obviously would like to be sure that what are the reasons for it, and obviously, go deep dive into the business and see that what all are the bottlenecks, where all are the competition hurting our customer, and we try to then come up with our predictions, our assessments that okay, this much amount is fine. You can't go even below this particular amount. The fourth piece is any kind of macroeconomic development that's happening and which might impact the particular business. Point in case is the jewelry business, wherein there are a lot of diamond merchants in the country doing flourishing business earlier, but ever since the lab grown diamonds have come out, The demand has really become low because of the suspicion that the general customers have. And so these guys are not enjoying those kind of turnovers which they earlier used to have. And so we are obviously not taking a punt on them, and we're shifting our focus to precious stones, semi precious stones, gold and silver jewelry. So these are the things, we generally, uh, these guys, we question them hard. We question them, just to check as to what are their backup plans. And obviously, through the assessments of the industry, of the similar businesses, we try to check, whether what's the worst case that can happen, and how can the person come out. See, always businessmen always stay very bullish, and it is appreciated also. But then we can't just go by their verdicts, their statements. They have to be cross-checked always. So that's how we go about it.
Thank you. Thank you, Piyush. Then my next question to you: how do things like environmental or social factors, that is ESG, that is environmental, social, and good governance issues, actually affect my chances of getting a bank loan approved nowadays? Because you know that every bank is concerned about their ESG compliance, that is sustainability of this environment. So can you relate the issues for approving a particular loan?
Yeah. So generally, the Reserve Bank of India, the central bank here, and even elsewhere, the central banks are the banks which actually take initiative in these regards, and they come out with policies. These policies clearly state that these are the businesses which are hurting the ESG compliance for the country, and even in general, they are hurting the environment. So they would try and come up with uh, certain policies where they will put these businesses into negative lists, and these businesses which come under negative list will not be funded anywhere. So banks generally are very conscious that whichever businesses fall under certain risks, these businesses are not funded. They become a strict no. Now, point in case obviously is any business which is into discharge of harmful chemicals, say garments. So if at all a business is using chemicals to create the colors, and these finally get discharged in the nearby water bodies, so these would not be funded. If someone is using organic colors, proper mechanisms, they and the person also has uh, kind of recharging water facilities, then that person can be considered
ETP,
for
that is effluent treatment plant, ETP plant.
effluent treatment plants. Absolutely. So these have become a mandatory compliance issues nowadays, wherein banks, whenever they do a field visit, they would check, and once they are satisfied, then only they are funded. Similarly, someone comes up with certain facility at a ecologically reserved area, which is green area, and you're making a factory somewhere near, so they become negative, listers. They are not funded because anytime government can have a crackdown over those industries. Anybody doing any kinds of arms and ammunition kind of a business is a strict no. So all these businesses which are harmful, so there's a place in India called Firozabad, wherein we had furnaces and we used to make bangles, glass bangles and chandeliers. Now, there they used to deploy child labor. They used to have harmful discharge of smoke because those furnaces would. So all these businesses then subsequently become a no-no, because with change of time and with more awareness, everybody becomes slightly cautious, and so banks they ingrain all these macroeconomic factors into their policies, and there they categorize which industries can be funded and which cannot be funded, and based on that they go ahead with their decisions. So that's how ESG is complied with.
Thank you, Piyush. Then I'm going to ask you that I keep hearing banks prefer short-term loans. Is it correct? And why exactly is that? And under what circumstances will they consider longer repayment periods?
Right. So generally banks go by their asset liability calculations. they would always like to have a kind of balance between their assets and liabilities. I still remember there was time when we used to have maximum fixed deposits allowed for about 9 years. Now it has perhaps got decreased to about 7 years or so. So when we are garnering some money for maximum 7 years of period, and the average money that comes to a bank through a savings bank deposit or uh, or a current account, that is a business account, stays with them for a very short period of time. They can't afford to have longer long-term loans. I mean, money is going to stay them for a particular period of time. That money is going to be used for funding the other loans. So they can't have a short-term, arrangement wherein they have to pay back to the customer in a shorter period of time, and the money which they get from the customer in terms of loan customer is going to be a long-term thing. So obviously they would like to strike a balance between the two. This is known as asset liability. Whatever money they borrow from various financial institutions also comes for a shorter period of time. So generally, they would prefer short-term loans, but in case of secured loans, they go for a long-term loans also. So in case of a housing loan in India, we can go up to 20, 25 years. In case of a loan against property, we can go up to general tenure starts from 8 to 10 years, 12, 15, 20, 25. uh, any person who's up till the age of 60, 65 at max, that's the his earning period can become an applicant. uh, a co-applicant can be maximum till the age of 70 years. So these are certain things which we kind of consider while deciding the tenure of the loan. But yes, there is an obvious balance of uh, short-term loans and long-term loans. Short-term loans actually bring profitability also, because these are at a very, very high yields, right? So the differential of what they earn and what they have to pay to the customers is very, very high, and so that they would prefer that short-term loans are given, or maybe credit cards are popularized. So that's the area.
Thank you, Bruce. So my last question to you then, uh, do you have any recommendation how I can improve my credit score to get working capital financing?
Yeah, so the basic is that whichever loan a person takes, he should ensure that there's a timely payment, right? Because this keeps on getting recorded on various forums, which give you a score, which are known as credibility scores. So, and that becomes a bible for anyone who's going to lend you further, right? So the stronger score that you have, better are the chances of you getting a loan, and you getting it at a best rate, right? Or at a better rate. The poorer score would fetch you a loan at a higher rate of interest. Nobody would like a loan at a higher rate of interest. That's that's very, very critical. And secondly, if at all things have gone bad, and because times can really be tough at times. So in case the repayments have been haywire, so one must have a smaller loan, maybe an overdraft facility, as I said earlier, against a fixed deposit, or against a maybe collateral piece of land or something, and pay it regularly for at least a year's time, 6 months to a year's time, and that would improve the credit score. That would create a track record that the customer pays regularly, and then you can really bank upon it, use it for your benefit. So these are the two things which come to my mind.
Thank you very much, Mr. Close, for your insightful speech. And it was really well timed and well expressed, I think, because you have shared lots of your experiences, lots of information with us. I think it will be very much helpful to all the participants. Uh, Thank you. Thank you for your contribution today.
Thank you, Mazhar. Thank you for having me over. And I hope I really addressed the questions in a way which can be beneficial. And last not the least, the quotes behind you are very inspirational. I could manage to read them, all three of them, and I found it really thoughtful. So thanks for those reiterations. Thank you.
you. And that's the end of our session today. Uh, uh, best of luck, all of you. Thank you.
Thank you. Thank you.